You're listening to Capital Topics, episode number 40. This is bi-monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In this episode, we'll discuss the following points. For our first topic, we'll discuss the TFSA and tax issues at debt. And next, for a second topic, we'll give you the second part of our pre-retiree guide to new retirement. Enjoy! Good morning, James. How are you today?
I'm very good, François. How are you?
I'm very good, thank you. So, in our last podcast of Capital Topics, we discussed the adoption of TFSAs by Canadians, some misunderstandings and common mistakes made by investors. In this episode, we want to tackle what happens with the money in your TFSA when you die. People are shocked to find out that the estate may owe tax on the gains inside the TFSA after the date of death.
Yeah, that's often asked by our clients when it's too late. And so it really should be on everybody's mind when they're opening an account, and their advisor should be talking about this and making them aware of the potential risk.
Mm-hmm. To me, it's a very, very important estate planning question that can make a difference to your family's wealth when planned correctly. I say this because from an income tax angle, although the fair market value of your TFSA prior to your death remains tax-free for the holder, the growth in the TFSA after your death could become taxable depending on how you planned things.
Well, exactly. Because any increase in the value of the TFSA after the holder's death and until the deceased's TFSA is closed out, it can be taxed as ordinary income, whether it's growth coming from interest, capital gains, Canadian dividends, or other investment income like foreign dividends and so on. So really important.
Yeah, exactly. So to reduce this potential tax impact, there are several steps you can take. First, in all provinces except in Quebec, there is legislation that permits a TFSA holder to name a successor holder or a beneficiary on their TFSA in case of death. The advantage of naming a successor holder or beneficiary is that you avoid your TFSA of going through your estate and being subject to probate fees. Furthermore, when you designate a successor holder, by the way, only your spouse or common law partner can be named as successor holder. When you pass, the successor holder can roll over tax-free your TFSA into their own TFSA, and this does not impact their TFSA contribution room. Also, if the TFSA continues to grow from the market value prior to the date of death to the moment it is rolled over, this growth can also be rolled over to the spouse or partner's TFSA, and this growth will not be taxed. Here's an example for you. So let's say Mark had a TFSA with a fair market value of $80,000 when he passed, let's say on January 16, 2021, and that his spouse, Carolyn, was designated as successor holder. When Mark's estate is settled a couple of months later, let's say August 10th, the fair market value of the TFSA has grown to $85,000. So in this case, the $80,000 in fair market value at the date of death is not taxable to Carolyn. Neither is the growth of $5,000 earned after the date of death, and the full amount of $85,000 can be rolled over into Carolyn's TFSA. If you designate a beneficiary, however, whether this is your spouse, your partner, your child, or someone else, the fair market value of your TFSA prior to your death can be distributed tax-free, but like James mentioned earlier, all the growth after that becomes taxable. This is a key difference between designated your spouse or partner as successor holder rather than beneficiary.
Well, the spouse or partner that is named as a beneficiary can also contribute the value of the TFSA prior to the date of death to their own TFSA without affecting their contribution room. And that's key. This ability to transfer the value in the TFSA. The estate's not paying any tax, obviously, because it was a tax-free savings account. And then that value is then transferred in. So it's like if they've been contributing at the same level, investing the same, sort of like doubles up the value of their surviving spouse. So it's very powerful, long-term for estate planning and for financial planning for the surviving spouse. But you can't take advantage of the tax-free growth in the TFSA after the date of death unless they're named successor holder, as you pointed out, François. So,
Mm-hmm.
you know, that growth can be contributed to the spouse's TFSA if they have the room. But that key difference is important, and it's not always the case, because generally what we see in clients is that both of them have been maximizing. And in fact, we encourage clients for income splitting purpose to, if one spouse doesn't have them, to gift it to the other every year, the contribution room.
Mm-hmm. That's right, James. And if you take my prior example, let's say Mark had a TFSA with a fair market value of 80,000 when he passed on January 16, 2021, and that his spouse Carolyn was designated as beneficiary. Again, when Mark's estate is settled in August, the fair market value of TFSA has grown to 85,000. Since Carolyn was designated as beneficiary instead of successor holder, the 80,000 fair market value at the date of death is not taxable to Carolyn, but the $5,000 in growth after the date of death becomes taxable as ordinary income.
And it's taxable to Caroline.
Exact. This process of transferring the TFSA is also a bit more complicated. There is a form to file with the CRA within 30 days of the transfer in order to obtain the special exemption. Also, you have to make sure to complete the transfer before the end of the calendar year following the year of death. If you have not designated a successor holder or beneficiary to your TFSA, your spouse or partner could still make an exempt contribution to their own TFSA without affecting their unused contribution room, assuming they are the beneficiaries of the estate under your will. However, probate fees would be payable to the province to validate the will and to then distribute the TFSA to the beneficiaries. Similarly, yes, James?
Yeah, just a reminder, probate fees is really, again, outside Quebec. Quebec has a civil code, so it doesn't apply to Quebec residents.
Totally. And similarly for residents of Quebec, since you can't name a successor holder or beneficiary to your TFSA except on insurance products, your TFSA assets goes to your estate and gets distributed according to your marriage contract or your will. Again, assuming that your spouse or common law partner is the beneficiary of your estate, they will have the option to make an exempt contribution of the fair market value at that of the deceased TFSA to their own TFSA.
Well, François, in this situation, similarly to the situation where you designate your spouse partner as a beneficiary, time is really of the essence, because any other growth in the value of the TFSA after the date of death will be taxable as ordinary income to the beneficiary of the estate. And so really you got to act quickly with TFSAs. So
yeah, totally. Also, if the beneficiary of the TFSA is not your spouse or partner, although the fair market value of the TFSA immediately before that can be distributed tax-free, the beneficiary can't contribute the proceeds from the deceased TFSA to their own unless they have the available TFSA contribution room. Finally, TFSA holders should know that once they pass, contribution can no longer be made to their TFSAs. Therefore, all their unused contribution room is forever lost. So one piece of advice here is if you or your spouse are critically ill, it would make sense to see if you or your spouse can maximize the TFSA. Yes, James?
We've seen this a fair bit with newer clients, and they come to us and one spouse is very ill. So that's one of the things we look out for, is to make sure that if there is unused room and the spouse is really having serious issues, to do whatever they can to maximize it. Because again, like I mentioned earlier, once they pass, you transfer it to both, and so it's like you're doubling up the total value of the TFSA. And where contribution rooms are at now, 81,005 plus, going forward, increasing every year, this is a real benefit.
Mm-hmm. Exactly. So that's it for my comments that I prepared for TFSA at that. Any further comments, James?
No, I think you've done a great job covering this, and hopefully our listeners have found that very useful.
Okay, so our main topic for today is the Pre-Retiree Guide to New Retirement, Part 2. Today's podcast is a continuation of episode number 39, where we tackle the psychological aspects of retirement planning. Today in Part 2, we'll cover the financial aspects of what listeners should know about how to best prepare for an imminent retirement. James, over to you.
Yes, okay. Like you said, in episode 39, we shared with our listeners the critical importance of first creating a vision of their ideal life in retirement. Once this, soul searching and introspection and reflection has been done, you're going to be ready to then address really the classic financial planning questions, which is how much capital are you going to need, when, and for how long. In other words, the big worry that everybody has is, will you have enough money or will you be at risk of running out? So again, financial planning experts, here in Quebec, it's regulated with the PLFIN. This is part of the core competency to be skilled at financial modeling, and we use advanced sophisticated softwares where we can simulate different scenarios to help pre-retirees understand whether their vision for their retirement is realizable and how sensitive it is going to be to them, not running out of money. So together with your advisor, really in this process, you start by a thorough discussion of the underlying retirement planning assumptions to be used in developing this plan. So once you've done that, the next step with the advisor is to begin by calculating your net worth. So you add up all your assets and liabilities, that's your debts, and get a solid understanding of what your personal balance sheet is, and then you're ready to go.
What do you mean, James, by retirement planning assumptions?
Well, François, there are two types: the assumptions that you have control over and the ones you don't have control over. And incorrect, or usually what we call too rosy, retirement planning assumptions are particularly problematic because by the time, a retiree or a pre-retiree realizes their plan is in trouble, they may have very few ways to correct the course other than spending less, often significantly less, and or working longer, as the only viable options to consider. So let's start with the retirement planning assumptions that you can control. Well, the first big one is your cost of living, or what we otherwise call your burn rate after tax. So forget tax for a minute because that gets complicated on its own. So this one is going to require a lot of work and thinking about what you want to do with your time at retirement. Regular recurring expenses, either monthly or annual, can be easily estimated. But non-recurring items, like for instance, travel. How much are you going to spend on travel? You're going to have unplanned healthcare. You're going to change your car. You're going to renovate. All these things, non-recurring, that requires more effort. So most clients come up with a fixed monthly amount for the recurring or annual amount, then you add it all up, and then you create a buffer, or you create budgets estimated for these non-recurring items. So this from there, we want to pensionize their investment pool as advisors, and we want to, really do those detailed cash flow projections. But it really starts with, what's your burn rate going to be? And that's a very critical number. And our listeners, you have control over that. And so that's
exactly.
important.
And we've had a lot of success with our clients as they get used to a regular amount, and we can carefully plan a portfolio withdrawal strategy to minimize costs, both in terms of taxes and market impact.
Well, again, this is a key insight I want to share with our listeners. Much to my surprise, because in our financial plans, we say, well, your cost of living is so much a year or so much a month, and then it's going to increase with an inflation assumption. Actually, we're quite surprised because we have many clients over a decade and they're still asking for the same number. And it's almost like they've had no personal impact from inflation. But in actual fact, well, we can argue that inflation has been relatively low, except since, totally. May of 2021. And so, maybe going forward, this is going to be very different. But I have the impression they take pride in carefully managing their financial affairs. They've been savers all their life, and they prefer not to spend down the money that they've built up over the years. So again, there's a psychological aspect to, of mental accounting and behavioral finance that, I've got this much money, and I get a security that amount is still there. And in fact, we've seen, because of the extraordinary returns that the markets have produced up to December 31st, 2021, excess returns, and we've talked about that in prior podcasts, clients actually find themselves with more money than they had 10 years ago, and they're spending the exact same amount per month, or they're drawing down the exact same amount. So again, it's quite phenomenal. So, but I will reiterate what I said in podcast number 39. Flipping the switch mentally is incredibly difficult. It triggers a fear response in our brains, and that could be part of the explanation of why people don't want to spend down their money. I have to say, however, that these same clients who are not spending down their capital, they're not unhappy. They're not, oh, geez, I wish I could spend here. I wish I could do this. The stories they tell me, they are leading a very rich and full life. So it's not like they're making major compromises with their spending choices.
Yeah, and I would add, James, here that savers tend not to be spenders. The burn rate will also be the key determinant for how you take money out of your portfolio.
Well, there you go. And I'm going to quote, somebody who's been doing a lot of research, academic research in this space, and he's a very credible guy, Robert Merton. He's professor of finance at MIT Sloan School of Management in Boston. He's also university professor emeritus at Harvard University. He received the Nobel Prize in Economic Sciences in 1997 for developing a new method to determine the value of derivatives. He's also the resident scientist at Dimensional Holdings, and we've seen him, in webinars and in conferences many times over the years. As you can recall, François, he has been doing, again, as I said, a lot of research on this topic, and his latest thoughts are, so what represents a good retirement income? No matter who is asking, I always give the same response: an inflation-protected income that allows you to sustain the standard of living you enjoyed in the latter part of your working life throughout the rest of your life. That is what you should be striving for with a retirement plan. And we've seen that in spades in our client practice over 20, 25 years, François, that it's very hard for people to adjust downwards their standard of living. They get used to that. And so, okay, once retired, they may spend more on vacation. But actually, clients retired, I'm always amazed at how they get to plan terrific trips at a fraction of the cost that I can plan them for, because I'm just too busy. My wife's too busy to have the time to look for all these deals. So, and they travel with friends, or they visit friends, et cetera, they have around the world. So again, having as an assumption that you're going to have a standard of living very similar to prior to retiring is a very, very good starting point for planning. So the next step is we're looking at the one-time expenses. Again, I mentioned, and I'll reiterate that examples are replacing cars. We bake that into financial planning projections. We're going to change our car every 8 years, and cars are much better than those made, 20, 30, 40 years ago. So they do last much longer. It can be gifts to children or grandchildren are a big item. As I mentioned, our clients earlier, they haven't burned down. In fact, their capital is higher, but now they're getting to the age where they're thinking, well, I want to transfer money to a warm hand, that is to my children that are still alive, while they can really benefit from that. Because again, with people's extended life expectancies, unless you're at risk of running out of money, but if you have excess capital in the financial projections, you can afford to gift now. We talked about RESP funding by grandparents, et cetera. So again, that's non-recurring items. Health and dental care. People are always worried about health, and we know that the research shows it's really in the last 2 years for most of people. But there are people who do get chronic healthcare issues that require extensive long-term care, but it's actually fairly rare statistically. Dental care, though, is the big surprise. We see clients with $30,000, $40,000, $50,000 bills for dentistry, and nobody sees that coming. So, message to our listeners is take care of your teeth, go to the dentist. Home renovation, and the list just goes on. So these expenses are very discretionary, and they can be deferred or cut back. So there's opportunities based on if the market did a great year where you can spend a bit more on travel or what have you, or you can spend, the market had a negative year and you can spend a bit less.
Yeah, you mentioned James gifting to children or grandchildren, and we see this a lot, and we even recommended to contribute to RESPs. We also recently published the Bank of Mom and Dad podcast number 36 for parents gifting money to their kids to buy their first home. So yeah, gifting money to kids is a big one-time expense.
Okay, so the next big element in the financial planning for retirement is picking the retirement date and whether you're going to continue to earn post-retirement employment income. Again, some people say, I don't want to work. So we run base case scenarios where they're not going to generate any. But again, it's perhaps, anecdotal in our client base where people have been highly successful. They've said they performant, we say in French, they've been high performers and they want to be committed. So often they have a lot to add. And so people want them so they can generate some form of consulting income and they like staying connected. So after you've worked out how much you'll be spending once you're retired, commit to a set date. So to stop working, and the plan is going to require this as an assumption. One great way to strengthen your retirement plan, though, is to keep working. Now, I've used this line for years. Every year you defer the retirement is like an extra 2 years of economic benefit because you're earning money and saving for an extra year, but you're also not tapping into your capital assets. If you're lucky enough to have defined benefits, you're earning an extra credit in the defined benefit pension plan. But again, that's part of the simulations. You can say with your financial planner, do you want to retire at 60 or 65 or 63 or 67 or what have you? So, every year you defer drawing funds from your capital makes your withdrawal plan more sustainable, longer, or your ability to gift to the next generation, much stronger.
Yeah, James, and you mentioned that people keep working after while they retired, but it's more than just money. You can find purpose and meaning in a retirement job. Part-time work in retirement is becoming very common. A 2019 study from AARP, the American Association of Retired People in the U.S., found that more than 20% of Americans over 65 were working or looking for work, about double the rate from 1999.
Well, as we say, people can be retired, 30, 40 years. That's a long time. Mm-hmm. So you got to find mission and purpose with that new phase of your life. So, yep. We see it a lot. Highly successful people need to stay connected and relevant. Mm-hmm. So now let's look at the assumptions you don't have control over. Stock and bond market returns. So again, the decade ending December 31st, 2021 generated higher actual returns than expected over the prior decade, and owing to the combination of high equity valuations and low bond yields going forwards, expected returns could potentially be much lower. So, or retired people are about to retire. Are they doing it at when a market is at peak, et cetera? So that's where we get into, a lot of work, and we've published papers.
Yeah, well, we covered this topic of expected return in our podcast number 37. So I recommend our listeners to review that podcast for more details on expected returns going forward.
It's a whole topic unto itself. But again, that's part of the assumptions that you don't have control, but you have to make them. The second was inflation. So now, and on everybody's mind, well, how will higher inflation impact my retirement plan?
Yeah, we've been talking quite a bit about inflation since 2021, May 2021. For pre-retirees, James, what are the implications for withdrawal rates?
Well, our advice on withdrawal rates is that pre-retirees may want to err on the side of conservatism with respect to starting withdrawals. We agree with research that concludes that an initial withdrawal rate in the low 3% range is safer starting point for new retirees with balanced portfolios. So that's really for people retiring in their 60s. If people are in their 70s, then that percentage would be higher because they've left years remaining to life expectancy. And, what is a balanced portfolio? Well, we're going to talk about that in a future podcast. We've hinted about this in the last year. What is a balanced portfolio? It classically was 60% equity, 40% bonds. Going forward, that could more look like 70-30. As rates have now risen tremendously, that pendulum, pendulums don't stop in the middle. They keep going the other way. It could be that we're going to end up with very juicy bond rates, and therefore it could be that 60-40 still makes sense. To be continued on that point. So,
and should be mentioned, James, that that the estimate of 3% didn't include an especially high inflation assumption to arrive at that low starting withdrawal rate. I believe that an inflation rate of 2.2% over the 30-year time horizon was assumed. That's in line with historical averages, but just a shadow of what inflation has been recently. The prospect of higher inflation amid a volatile market environment like we have right now makes a lower starting withdrawal rate even more prudent for retirees going forward.
That's a very good point you make, François. And another point which I think our listeners should be aware of is it was made by John Reckenthaler, who is one of the analysts and writes for Morningstar. He pointed out in a recent Morningstar Roundtable article that when the inflation occurs in retirement is crucial. He says, like a weak market environment, inflation in the early years of retirement is especially harmful. That's because higher spending early in retirement builds upon itself and leaves less of the portfolio in place to grow throughout the retiree spending horizon. So again, if all of a sudden you said your cost of living is going to be, $8,000 a month, and then you start off and it's, 10 or 11 or 12, this can materially impact your plan. So those, listeners should know that you should be working closely with your advisor in those early years to make sure, geez, we plan this as that's what's actually happening. So we always tell people it's going to take you a year or two to really get a true feel of what your cruising speed is with your burn rate.
Okay, another idea, James, to reduce your spending plan's sustainability to higher inflation. The decision about whether to own a home or rent one is obviously about much more than inflation, but a major financial benefit of home ownership is not having such a big expense buffeted around by inflation.
I agree with that, François. We see it, over 80% of Canadians own their home without any debt. So if you're mortgage free, you control your costs, fairly closely, particularly in regions of the country where energy, like here in Quebec, it's based on hydroelectricity. So heating and cooling and air conditioning, is fairly stable cost. So the next variable of which we obviously have no control is life expectancy. So what we do in the planning work is we want to make, and this is a conservative assumption, is that we want to make sure you don't run out of money. Well, we make you live a very, very long time. So the assumption is usually done with a 90% plus probability that a client will be deceased. So we have tables here from our L'Institut québécois de planification financière. And, generally it brings people out to age 93, 94, 95. And again, if both spouses are healthy at age 60, there's an over 50% chance that they're gonna, one of the two of them is gonna live to that age. So it's not conservative an assumption. There's a high probability that it's going to occur. So again, we're going to have a future podcast on this topic on life expectancy alone. So more details and to be continued.
Yeah, it is very important because some believe that it's the biggest risk they face. Will they outlive their money is the question.
Okay, so my final comments about assumptions, François, is that, again, the goal is to avoid over-optimism about those assumptions. What does it mean to be conservative in selecting assumptions? Like I mentioned a little earlier, with life expectancy, you have over 90% probability that you will have passed. So other examples are using lower expected returns, even though we may assume that this is what's going to be going forward, we can still adjust those downward. So that gives us a margin of safety. Those are easy to do with the financial planning software. And then we can also put a slightly higher burn rate, more margin of safety to cover unforeseen chronic healthcare expenses. That said, a lot of clients worry about those healthcare expenses, but generally our clients own their home. And at that point, when you're ill, often you're going to sell your home. So that can be, if the tax code rules don't change, your principal residence, and that's usually a source of capital to help pay some of the unforeseen healthcare costs. So the next point is there's the next three components of retirement financial planning. Again, will be covered in future podcasts, because to really cover them properly, you have to go in much more detail than we're going to do today. And that's pension income planning, when to take the government pensions, old age security, CPP, or here in Quebec, the RRQ. Take it early as before age 65 for CPP, or at 65, or defer sometime up to age 70. And then the old age security, it's the same thing. You get it at 65, or do you want to defer it to a later age, because you may be getting clawed back in earlier years. And then, your private employer's registered pension plans, particularly if you've got defined benefits where, you've had many years of service and there's different options to select. Those are key elements that you have to drill down on. Okay, so the next element is the tax planning around your drawdown strategy. In our end of year podcast, where we talk about year-end tax planning, we focus on retirement income optimization. So for our listeners who are newer, podcast number 29 and 30 last year covered that, and we plan to review it again at year end. So here we look at the specifics of, from which account we should take the money first. Is it your registered accounts, RSP, or if you've converted to RIFs? Is it your TFSA? Generally, we like to keep those, tax sheltered, tax-free sheltered money in the account as long as possible. Whether you take it a personal, taxable accounts, or holding company accounts where you've accumulated, funds over the years.
Yeah, how to withdraw your investment is critical, very important to your long-term capital preservation and sustainability of your withdrawal plan. And as you mentioned, James, this was covered in our podcast number 29 and 30 at the end of last year.
So the next variable, and this is something that we, in the profession, spend a lot of time thinking about: what's a sustainable withdrawal rate, and what's the capital required. And so that's where the software will tell you, well, is your burn rate sustainable or not? So someone that our listeners know, because we mention him or quote him often, Ben Carlson. He's an investment expert blogger in the US, and he has a great quote in one of his recent blogs. We only get one chance when it comes to saving and then drawing down our retirement assets. So that's why it's such a big topic on your own. Like, it's not like you have 12 different chances. Again, some people may go back to work full time just because they get bad luck, but for most people, that's not an option. So financial planners, we use software doing that computer modeling, as we mentioned earlier, but there's a module that's called Monte Carlo analysis. And that's a statistical model that runs all different scenarios. And we generally do 500 simulations. You can do more and do less. But 500 seems to be a good number. And so instead of projecting straight line your portfolio, we estimate it's going to increase, 5.5%. It varies, and it assumes, you may get a run of 4, 5, or 6 years that are not great, and then so on. So it does those simulations to calculate the probability of reaching your financial goals. And again, based on the assumptions that you've input, obviously, in the software. And again, primarily focus on how much inflation adjusted income you need and the market performance. So those are the two key variables.
Yeah, it can't ensure success, but it can give an investor the confidence that their plan is sound, or an early warning that their plan needs some attention.
Absolutely. So people are living longer, working longer, and looking at retirements that may span 30 to 40 years. And so today, a 65-year-old retiree needs to be a long-term investor. We've been talking a lot about this, the long-term investor mindset. And that's something we see, now I'm retired, or I'm 60 or 65 or whatever, and now I got to all go into the safe bucket and not take capital market risk. Well, if you're going to be living, 30 years beyond your retirement, or 35 or 40, well, you need the growth from that equity is going to give you. So, a 65-year-old retiree, with a portion of their portfolio invested in equities 15 or 20 years ago, well, that was much lower. Now, we have our clients with significantly more money invested in equity. There was an old rule, and John Bogle, founder of Vanguard, commented on this in the middle of the global financial crisis. And that says, oh, well, with your fixed income, your safe bucket should be equivalent to your age. Well, that formula worked fabulously with an interest rates were 4 or 5%. But in today's market, unless the pendulum brings us back there, where we can reconsider that excellent basic rule of thumb, now it's very different. So you want to have at least 15 to 20% more in equity generally, if you can tolerate that volatility. It is ideal for clients now in terms of retirement. So money, but you should always be careful that in terms of your cash flow needs, you should always plan that your safe bucket's going to cover very minimum 5 years, but ideally 10 years. We like the 10-year rule better. And it's readily accessible in safe and liquid investments.
Yeah, and on the other hand, James, interest rates on bonds have moved up year to date, and that will mean that extra income on the safe component of retirees' portfolio.
Which is why when we said recently in my blog on bonds and in our podcast about rising interest rates, this is a good thing, because most investors, their duration is their life expectancy, which is much longer than the duration of their bond portfolio.
Yep, short-term impact, but a long-term gains.
Yes. So the portfolio drawdown rate, or the withdrawal rate, is a starting point in assessing the appropriateness of an investment asset allocation. Annual withdrawals can be used to help determine how much to hold in cash and bonds. Like I mentioned, we want 5 to 10 years of buffer to make sure if you've got volatile equity markets, then at least we can count on the safe component of your portfolio to cover your cash flow needs.
Yes, and tax optimization is very important when planning withdrawals for client. That's why we like the flexibility of our portfolios that are built with several broad-based stock and bond ETFs rather than all-in-one product. This is especially true for larger accounts.
So let's get back to Robert Merton. I think he had another quote in a short article published weekly, which we'll share with our listeners from that was published by Dimensional. And he's talking about setting your asset allocation at the onset of retirement. And I quote him, "Taking on more investment risk may seem like the way to go, but it's important to have a backup plan. Don't count on higher returns being a sure thing. Risk is real, and if taking risks is part of a solution, then one must be prepared for what to do if the risk is realized by, say, a big stock decline in your stocks during retirement." And right now, there are many smart people in that we follow that are talking, well, don't expect a V-type recovery in this market down that we've seen in 2022. Because, if you look at what happened with the pandemic and, in 5 weeks, equities dropped to 35 some percent, from peak to trough, maybe closer to 37%, I believe. So, and it bounced back so quickly. But you had all this fiscal and monetary stimulus. So this time around, they're saying, well, if we're down for a certain period, it could stay down for a while. So again, these are all variables that need to be discussed when the financial planning, modeling that's being done for you. And you really need to get a good understanding. So even though I said earlier, the economic environment is you should have a higher equity allocation, maybe would have been recommended, 15 years ago for a typical retiree. You have to really make that decision so that you can stay the course for the long term. So again, I'd like to end our podcast segment with some thoughts from a 98-year-old American investor who's pretty legendary, Taylor Larimore. And he is known as the king of the boggleheads. So boggleheads are people who, read Jack Bogle's book he published, 40 years ago or so. And so he invested with John Bogle's principles, and he's a preacher of the investment philosophy of low fees and high diversification. And Larimore was recently interviewed in a recent article for the Bogglehead community online, and he told the author, "The keys to financial independence are to live below your means, save regularly, keep costs and taxes low, avoid large mistakes, keep things simple, and stay the course. Lara Moore said the biggest mistakes people make are gambling in individual stocks, using past performance to predict future performance, building complex, high cost, and tax inefficient portfolios.
Very wise word for our listeners from an investor with a long-term mindset here. So I hope our listeners have found this topic insightful and useful as they think about their vision for the next phase of their lives. Thank you, James, for sharing your thoughts and expertise today.
My pleasure, François.
So that's it for episode number 40 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our podcast, please share it with family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode very soon. Thank you.